You got the obvious bases covered. The house is off limits until valuation. The joint savings account is frozen. Your 401k statement is printed and highlighted. You think the major assets are locked. So you exhale, tell yourself the worst is contained, and focus on surviving the paperwork grind. But while you're guarding the front gate, 9 valuables are slipping out the side door. Items so easy to overlook, they don't even appear on many standard financial disclosure forms. Unvested stock options that triple when the market rebounds. A pension credit that snowballs in value every month you stay at the job. That harmless health savings stash you funded for years of future medical bills. Even a mountain of airline miles quietly waiting in her email inbox, ready to bankroll the vacation you promised yourself after the dust settled. Except she'll be taking it without you. Here's the brutal truth. Divorce isn't just about who gets the couch and how to split the checking account. It's a forensic hunt for every dollar that exists now and every dollar that could exist later. Courts will divide what they can see. Your ex's attorney will hunt for what you forgot to protect. And if an asset isn't identified, valued, and barricaded before negotiations heat up, it becomes a poker chip she can cash while you're still counting the chips you know about. By the time you realize a silent 529 or a side hustle royalty stream was marital property, the paperwork is signed and the value is already flowing one direction, away from you. This video pulls the cloak off the 9 stealth assets men most often overlook. Because the difference between a fair settlement and decades of silent regret isn't usually the house or the bank account. It's the valuables no one warned you could disappear without a trace. Buried deep in your HR portal sit the company's golden tickets, unvested stock options, and RSUs you barely think about because the vesting dates feel distant. But to a divorce attorney, those future shares are low-hanging fruit with a delayed payout. Family courts treat equity grants earned during the marriage, even if they vest years after separation, as marital property unless your agreement says otherwise. Picture this. The divorce finalizes in March. Your tech company's share price doubles by Christmas, and the tranche that hits your account is already half hers because no one carved out post-separation growth. Worse, option grants issued after filing can still be labeled deferred compensation for past marital effort, meaning the work you'll do next year fund a settlement you thought was closed. If you hold incentive stock options, ISOs, exercise windows, and AMT surprises can magnify the hit. She claims her share of the paper value while you shoulder the tax bill at exercise. The fix is a coverture formula written into the decree. Total marital months divided by total vesting months determines just a portion earned before separation. Insist on a valuation date snapshot, so any share price surge after filing lands in your column, not the communal pot. And don't let vague language like "to be divided upon vesting" linger. Outline whether she receives actual shares or a cash offset, who pays the exercise cost, and how taxes are reimbursed. Capture that in a separate property schedule, so future HR grants, yearly refreshers, retention bonuses, performance RSUs, are presumed yours unless explicitly listed. Because if you skip this step, the most lucrative payday of your career could arrive pre-divided, leaving you staring at a brokerage statement that proves the marriage ended, but the financial umbilical never got cut. Your 401k isn't the only retirement engine humming in the background. If you're a teacher, firefighter, military officer, or long-timer at a legacy corporation, you're probably accruing a defined benefit pension. Those monthly checks that feel light today, but explode in value the closer you get to retirement age. Family lawyers call these time bombs because their true worth is disguised by small current statements that list points or service credits instead of big dollar signs. Courts view every year of service during the marriage as marital property, even if the payout won't start until you hit 60. Here's the trap. Many men assume splitting a pension means each spouse gets a slice of the monthly check later. But there are two very different methods: shared payment and separate interest. In a shared payment split, your ex doesn't see a dime until you actually retire. That incentivizes her to lobby for a later retirement date and can entangle you for decades. A separate interest QDRO, by contrast, converts her portion into her independent payment stream. She chooses when to start, and you regain control of your own timeline. If your decree doesn't specify separate interest language, you could be chained to her retirement strategy for life. Even scarier is the multiplier effect. Pension formulas balloon in the final years of service when your salary peaks. Suppose you logged 15 marital years in a system that multiplies final salary by years of service. When you tack on another decade post-divorce, her covert refraction still applies to that fatter final salary, giving her a windfall tied to raises she had no part in. The solution is an actuarial valuation dated to separation, a snapshot converting service credits into a present dollar value. You then offset her share with another asset today, or cap the numerator in the coverture formula so it freezes at separation months. Don't forget government retirement add-ons like used sick leave credits and COLA escalators. They can add 5 figures over a lifetime and will default to marital property unless carved out. Bottom line, if you don't dissect the pension on the front end, you'll feel its drag decades later, when you realize the promotion you work for also boosted a monthly check that still has your ex's name on it. Your pay stub only tells half the story. The real money often drops in a lump. Year-end bonuses, sales commissions, performance kickers, or deferred compensation payouts that land after tax season. In the adrenaline of separation, men focus on current salary because that's what the court's income line item demands. Meanwhile, her attorney is eyeing the calendar. When does his company issue bonuses? A $30,000 performance check hitting 2 months after filing can still be classified as marital if the effort that earned it happened before separation, or even if it reflects ongoing projects initiated during the marriage. Judges frequently apply a pro rata split, bonus amount times marital months divided by earning period. That means the Christmas payout you're counting on to reset your post-divorce budget could arrive pre-docked by 40 to 60%. Worse, many executive packages include deferred comp that vests annually for tax deferral. Those dollars grow untouched in corporate accounts, invisible on basic pay statements, then surface years later, right when you're rebuilding. And guess who still has a claim because the plan was signed while you were married? Defense requires foresight. First, pull your employment contract and incentive plan documents now. Don't rely on HR summaries. Identify every payout schedule, quarterly commissions, annual profit shares, multi-year deferrals. Then timestamp your contribution. Detail projects closed, revenue posted, milestones achieved after separation. If a bonus period straddles the filing date, propose a carve-out formula so only the pre-filing fraction is marital. For long-term deferred comp, negotiate a present value buyout or assign her a flat dollar credit today. Never leave language like "to be divided when paid" floating in the decree, or you'll be cutting 10 years older checks to someone no longer in your life. Finally, require employer verification of all incentive plans. Signed HR letters that list grant dates, vesting calendars, and projected values. Courts respect third-party data more than spouse testimony, and those documents anchor your argument that future performance equals separate property. Without that groundwork, you'll watch a hard-earned bonus hit your account, only to transfer most of it out the next day, an aftershock that feels like the divorce happening all over again. The quiet, slow-drip bank account most men forget is the health savings account, especially if you've been feeding it for years under a high-deductible plan. An HSA isn't use it or lose it. It's portable, grows tax-free, and in retirement functions like a stealth IRA for medical costs. I've seen balances north of $40,000 vanish in the settlement because the owner assumed it was tied to the health insurance policy and would simply stay with whoever keeps the plan. Not so. Courts treat the entire balance as divisible cash, and if you don't flag it, her attorney will happily request half. Then reimburse future yoga classes, orthodontics, or even laser eye surgery with money you thought was tucked away for your post-50 health. The cousin to the HSA, the flexible spending account, can be looted even faster. FSAs reset every plan year, so a savvy spouse will schedule braces, elective procedures, new prescription glasses for every child, and drain the pot in November, right before a December settlement conference. You'll discover the $5,000 balance you listed on the financial affidavit now reads $312, and the receipts are already submitted. Shielding these accounts is about timing and documentation. First, print the exact HSA balance on your date of separation. Treat post-separation contributions as separate property by halting payroll deferrals until the decree is inked. Next, lock the debit card. Most providers allow dual authorization or at least online transaction alerts. Enable them so every withdrawal pings your email. For FSAs, demand mid-year statements and stipulate in temporary orders that reimbursements over a set threshold require dual signatures. If she insists on using FSA funds for the kids' treatments, trade dollar-for-dollar credits against support or extracurricular fees so the drain is accounted for, not invisible. And when drafting the final decree, don't just list the balances, spell out who gets the HSA custodial rights, how future contributions will be classified, and what documentation is required for withdrawals. Without that granular language, you might think you safeguarded a medical war chest, only to wake up post-divorce and realize the only health expense it covered was the cost of losing it. Sitting in a dusty file drawer is a life insurance policy you bought back when diapers, not divorce decrees, kept you up at night. Maybe it's whole life, maybe universal, but one thing's certain: it has accumulated cash value like a slow-growing savings bond, tax-deferred, quietly compounding. Because premiums auto-pay, you've stopped thinking about it, but your spouse's attorney hasn't. Cash value counts as a marital asset, and the policy can be tapped two ways: surrender it outright and split the check, or, more subtly, take a policy loan that leaves the death benefit intact while siphoning money today. If you don't lock the policy in temporary orders, she could borrow against it with a single phone call. Insurers rarely require dual signatures. Those loans accrue interest, eroding the payout and sticking you with a future tax bill if the policy lapses. Worse, many men sign decrees that say each party shall maintain existing life insurance for the benefit of the minor children. Then forget that the beneficiary language still lists the ex-spouse, not a trust. Fast forward 10 years. You've remarried, the kids are grown, and you die. The seven-figure death benefit bypasses your current family and lands in the lap of the person who once promised, "I'll change it after the paperwork's final." Safeguarding this asset demands a three-pronged approach. First, obtain an in-force illustration, current cash value, outstanding loans, surrender penalties, and list it on the financial affidavit so it can't disappear unnoticed. Second, draft a court order freezing any policy loans without mutual written consent and stipulate that maintenance premiums be credited towards support calculations. If she benefits from the future payout, she should share today's cost. Third, create an irrevocable life insurance trust or name the children directly, not the ex, as beneficiaries, with a trustee you pick to manage proceeds. Provide proof of beneficiary change to the court and keep annual statements as exhibits in case enforcement is needed later. Because a policy you forget is a jackpot someone else will remember, and the only thing worse than paying decades of premiums is realizing the money won't protect the people you love now, because you didn't defend it when a marriage ended. Hidden in plain sight, stacked across airline portals and hotel apps, are digital currencies that can dwarf a modest savings account. Frequent flyer miles, credit card reward points, and travel vouchers you've accumulated from business trips and sign-up bonuses. Because they live in loyalty dashboards, not bank statements, these balances rarely make it on as standard disclosure forms. Yet 300,000 airline miles can translate to $4,500 plus in airfare, and a six-figure Amex membership reward stash can book luxury vacations or wipe out gift card catalogs. During divorce, unclaimed points become a stealth asset your spouse's lawyer can either overlook, costing her leverage, or weaponize, costing you thousands. Airlines consider the account holder the legal owner, but family courts view rewards earned during marriage, especially via joint spending cards, as marital property. If you ignore them, her attorney might demand half the cash value or insist you book equivalent travel on her behalf after the decree. Worse, programs like American, Delta, or Marriott let members share or gift points. A quick transfer to her parents' account on the eve of disclosure can make miles vanish with zero paper trail unless you subpoena loyalty ledgers. Protecting, or at least equitably valuing, these digital assets starts with screenshots. Capture each balance the day you separate, including companion certificates and unused flight credits hiding in email. Next, convert points to a neutral dollar figure. Industry rule of thumb. Airlines at 1.3 to 1.5 cents per mile, hotels around 0.8. Propose an offset. She keeps a bigger slice of checking, you retain the miles, or agree to split by transferring half after final judgment. Pay any transfer fees jointly. If the program bars transfers, offer to book a mutually agreed trip for her portion, with cost debited against support. Not an open-ended promise to be her personal travel agent. Finally, freeze outgoing transfers and temporary orders and enable two-factor on all loyalty accounts. One midnight redemption could drain the kitty before anyone notices. Points feel intangible, but once you see the dollar tags attached, you'll realize a frequent flyer balance is just cash wearing a digital disguise, and in divorce, every disguised dollar you overlook lands straight in someone else's vacation fund. The riskiest assets are the ones that fit in a password manager, not a safe deposit box. Bitcoin on a cold wallet, Ethereum staked for yield, Solana buried in a DeFi liquidity pool. Crypto is tailor-made for divorce mischief. Transfers are instant, borderless, and if you know what you're doing, harder to trace than cash under a mattress. Courts recognize cryptocurrency as marital property, but discovery protocols still lag behind the technology. Many financial affidavits don't even have a dedicated crypto line. That gap is an invitation. I've watched spouses lose a hardware wallet during a move, claim exchanges lock them out, or stage a convenient market crash by transferring coins to a fresh address moments before the valuation date. Then, after the decree, the same wallet reawakens on-chain, flush with tokens that rode the bull market you never shared. Your defense begins with blockchain basics. Every major network is public ledger tech. Transactions are forever if you know where to look. Subpoena exchange statements from Coinbase, Binance, Kraken, plus K1s from any crypto funds listed on tax returns. Ask for wallet addresses in interrogatories. Refusal can be framed as concealment. Hire a forensic analyst to run chain analysis. Track outgoing coins to new wallets, flag mixer services, and estimate current value. Build a timeline showing deposits funded by marital earnings and freeze them with a court injunction. Most exchanges comply when served. Insist the decree specify division by percentage of coins, not fiat value on signing day. Crypto's volatility means a $50,000 split today could be $200,000 tomorrow, and a fiat clause locks you into yesterday's price. Finally, secure your own holdings. Move personal coins to a fresh wallet, double encrypt seed phrases, and store backups offline. Because in the crypto world, possession of keys, not claims, is 10/10 of the law, and if you don't police the blockchain early, those digital dollars can ghost you long before the judge bangs the gavel. You've been grinding nights and weekends on a passion project, an ebook that sells on autopilot, a coding tutorial you host on Udemy, maybe a YouTube channel that finally hit AdSense payout thresholds. The income feels like pocket change next to your W-2, so you list it under miscellaneous. Big mistake. Intellectual property isn't just about present cash flow. It's a faucet that can pour money for years, and divorce court treats that future stream the same way it treats rental income or stock dividends. Worse, IP often has low overhead and high margin, which means every post-divorce dollar it generates is mostly profit. Profit your ex will argue she helped make possible by supporting you during development. If the asset isn't identified and valued now, she can return later claiming undisclosed property or, in some states, sue for a share of post-decree royalties. Start by inventorying every platform that pays you. Kindle Direct Publishing, Gumroad, Etsy Patterns, Shutterstock Photos, App Store downloads, Patreon tiers, even affiliate links on that hobby blog you've ignored. Pull 36 months of payout history and chart the trend. Courts look for consistent earnings to justify valuation, and 3 years tells a compelling story. Next, project future revenue using a discounted cash flow model. Yes, that sounds MBA-ish, but a simple spreadsheet. Average monthly income minus platform fees, grown at a conservative rate, discounted back by 10 to 15%, produces a present value a judge can grasp. Offer her a buyout. You keep 100% of future royalties in exchange for a lump sum offset today, or carve out a declining percentage, say 25% year 1, tapering to 0 by year 5, to reflect diminishing marital contribution. Put audit language in the decree, allowing her to review platform statements annually for accuracy, but cap the look-back window so you're not forever opening your books. Finally, trademark your brand and register copyrights if you have it. Formal filings prove ownership and make valuation cleaner. A side hustle royalty stream looks small when compared to a salary, but compound it over a decade and it can rival a retirement account. Protect it like one, or prepare to share your creative payday long after the marriage storyline fades to black. Lurking in closets and climate-controlled basements are assets that never show up in Quicken but can eclipse a savings account. The Rolex you bought as a reward, the sneaker wall insured for pennies on the dollar, the vintage comic collection sealed in Mylar, the burgundy bottles aging toward five-figure auction prices. Collectibles carry a peculiar stealth. They're portable, often purchased piecemeal with discretionary cash, and easy to misplace during the chaos of moving boxes. Courts treat them like furniture until someone provides an appraisal. Without documentation, they default to garage sale valuations, which means your $18,000 Submariner gets listed as men's watch, $200. By the time you notice, she's already petitioned to keep it as sentimental or, worse, sold it to a dealer for quick liquidity. Preventing that quiet heist starts with a camera and a spreadsheet. Before anyone packs a single box, photograph every shelf, drawer, and storage bin, close-ups of serial numbers, grading certificates, receipt scans. Then cross-reference those images with current market data. Auction hammer prices, StockX, or eBay sold listings, wine searcher averages. Present the court a sworn inventory complete with appraisal letters or at least printouts proving replacement value. Judges can't divide what they can't see, and documented value deeders, I never saw that defenses. If items are slated for sale, insist on a mutually agreed auction house and escrowed proceeds. No private party cash deals. For pieces you'd bleed to lose, offer an offset. Let her take more checking account dollars while you retain the tangible asset, but put a stipulation in writing that any future sale above today's valuation triggers a percentage kickback until a set date, protecting against underreporting now and windfall later. Finally, add a clause in temporary orders banning the removal, transfer, or storage relocation of collectibles without joint written consent. Courts enforce property restraints far more easily than they unravel vanished heirlooms. Because a collection is more than stuff. It's a stored version of your discipline and taste. And once it walks out the door, no ruling can resurrect its history or its market climb. Guarding the obvious assets is Divorce 101, but real protection starts when you stop thinking like a homeowner and start thinking like a forensic accountant. Equity grants, pensions, deferred bonuses, healthcare cash piles, life insurance value, reward points, crypto wallets, intellectual property royalties, and high-end collectibles. Each hides in a different corner of your financial life, and everyone can walk out the door if you don't spotlight it before negotiations begin. Courts split what they can see. Spouses exploit what you overlook. The fix isn't paranoia. It's documentation plus strategy. Screenshot every loyalty balance. Pull in-force illustrations. Subpoena exchange ledgers. Hire a vocational expert for unstated income. Demand third-party appraisals for anything that clicks above $1,000 on eBay. Timestamp your evidence to the date of separation so post-filing growth lives in your column. Insist on precise carve-outs. Covert your formulas for equity and pensions, percentage splits for crypto, declining royalty shares for IP, so future windfalls don't retroactively become marital. Freeze access where you can, dual signature requirements on HSAs, no loan clauses on life insurance, court orders locking mileage transfers. And always offset, never omit. Trading a liquid asset for a hard-to-value collectible is smart. Surrendering it for free is self-inflicted. Most important, bake audit language into the decree. Yearly statements for deferred comp, blockchain address disclosures, inventory reviews for collections. Accountability deters disappearance. Because the difference between walking away solvent or spending a decade paying for an invisible asset is decided long before the judge signs. At the moment you choose to treat every corner of your balance sheet as contestable territory, do that, and the settlement stops being a list of losses and starts looking like a launch pad for the life you actually want after the paperwork is stamped.